In this video, I'm going to show you a method of trading which can achieve win rates of over 90%. It uses an indicator called Williams %R to identify pullbacks in an uptrend. The strategy which I'm going to show you is one that I've previously shared here on YouTube. I created it and published it back in March 2021. That means that I have about 3 years worth of unseen or future data since I first created the strategy, and it gives us a really good chance to see how the strategy's been performing. And I'm pleased to say that it has been performing well. And in that 3 years of that out of sample data, it's given us a win rate of 95%. I'll leave you the link for the original video, which shows you the exact steps I used to create the strategy in the first place. But in a moment, I'm going to briefly go over the rules for those of you who haven't seen or don't remember that original video. Once we've seen how the strategy works, I'm going to go over the recent results in detail and then share my thoughts on the up-to-date performance. And then after that, I'm going to briefly discuss how we can achieve such high win rates and talk about the pitfalls which actually comes with them. So what market does this strategy work on and how do we trade it? So this strategy works on the daily chart of the FTSE 100, and the data that I'm going to be using is CFD data for the FTSE 100. We're going to be using Williams %R indicator with a length of 14. Rule number 1 is when the Williams %R indicator is less than 20, or the lower percent of the range on your chart, then buy the next bar at the open. Number 2, we are using a trade filter. We want to see that we're in a longer term uptrend, and we do that by making sure that the close is greater than the 200 simple moving average. Trade exits, really easy. We're looking at the bailout exit or first profitable close. What that means is at the end of the day, we look to see if we're in profit, we exit the trade. If we're not, we leave the trade open. It's that simple. Looking at an example on the chart, down below we've got our Williams %R indicator. This blue cyan line is the 200 period moving average, and you can see that all of the data is above the moving average, so that's our condition to say that we're in a longer term uptrend. And we can look for short-term pullbacks based on the Williams %R. The lower horizontal line down here is that 20 level, and you can see every time the indicator dips below 20, so we get a buy signal. We exit as soon as we see profit. In this case, it was on the next bar or the next day. Another entry here, exit the next day, another entry here. That one took 1, 2, 3, 4, 5 days. Another entry here, and that one took 3 days. So really easy to spot the trades on the chart. When I developed the strategy originally, I used Oanda CFD data back to 2008, but on this test I'm actually going to extend that back to 2005, and then I'm going to do a cross-check using some LMAX CFD data too. We've got 2 charts within this workspace. One is using the Oanda data, which is the top one here, and then the lower one uses the LMAX data. I haven't got as much LMAX data. In the Oanda one, this is essentially what we saw in the original video. If I show you what data I've got from January 1st, 2005, in fact in the original video I used from 2008, so we've got an extra 3 earlier years, through to March 2021, which was about the time which I developed the strategy. And in the LMAX, we haven't got as much data back, we've only got back to October 2010, and again through to March 2021. So looking at the performance report, that's what the equity curve looks like. The green dots showing new highs. It's showing new highs pretty much all along the way. Got an 87% win rate, average trade of £422. Periodical analysis, looking at the annual period analysis, you can see that every year bar 2014 was a winner. Now some of you might actually question why we've got some losses, and you'd be right to do so. Remember I said in the rules, our exit, or our only exit, was a bailout exit, meaning that we exit only into profit. So then why have we got some losing trades? Well, the way I've programmed it is I look at the close of the day, and if the close of the day is in profit, then I'll exit next bar at market, and that means it's exiting at the next open. And in some cases, what that means is the opening price may have actually dropped below what the closing price was. So if the closing price showed a very small profit, then the market opened and it gapped down slightly, then we could be exiting at a very slight loss. And that's why we are seeing some losses. Let's just have a look at the cross-check Let's go over to the LMAX data. That's what the years look like. Equity curve is going to be fairly similar. Total trade analysis. Got a higher win rate now. We've got less data, remember. We've got less trades. And the average trade is £402 on the LMAX data. Now let's see what the out of sample data looks like. Let's look at a date range going from March 2021 through to February 2024. Same again, we've got the Oanda data on the top here, LMAX down the bottom. And this time we've got exactly the same date range for both sets of data. That's what the equity curve looks like. This is the Oanda data. Percent profitable was 71%, average trade £370 has gone down slightly. Let's have a look at the LMAX data. The average trade on the LMAX data is much higher, it's £550 and a much better percent profitable, over 95% profitable. Looking at the equity curve, it's going to be reasonably similar. The reason there are differences in the results between LMAX and Oanda data is because they're both CFDs and they do actually have slightly different session times. They're not going to be identical. This isn't futures. So we are going to get different trades. For example, here we've got a buy trade here and we didn't exit, whereas on the LMAX we exited and we had an additional buy trade. Same here, we've got a couple of buy trades on the LMAX data and none on the Oanda data. So while the data sets aren't exactly comparable, I am happy that the strategy works well on both the data sets, and that suggests some sort of robustness to me. We can see that this strategy clearly still does have an edge. The performance in the last 3 years has been very good. Using the bailout exit is what allows us to get very high win rates in this strategy, because it only exits trades when we see a profit. However, remember what I said earlier, high win rates don't always come without pitfalls. You would have probably noticed from the videos that I haven't been using a stop loss. I did do some testing in the original video using a fixed point stop loss, like a 50-point stop loss or an 80-point stop loss, but I found they all drastically reduced the performance of this strategy. And that leads us into pitfall number 1, which is not limiting our risk. If we're not using a stop loss and our only exit is the bailout exit, which is an exit into profit, in theory, what we could do is we could buy a dip in the FTSE for the FTSE never to then rally above our entry price and get us out. It could continue to fall and fall, meaning we're going to have a massive losing trade on our hands. Looking at our test data since 2005, the FTSE has never done this. It's always continued to make new highs, but theoretically it is possible. The way I'd combat this is to use some sort of a stop loss method, maybe not a fixed point, but a different stop loss, or introduce some kind of way of reversing the trade if it goes too far against us. I also think an additional timed exit could work too. For example, getting us out of the trade after X number of days or X number of weeks, if not in profit. And the second pitfall is the time which we're holding trades. You'll see on the chart that quite often we'll get a dip and we'll buy, and then we'll see a quick rally and we'll exit. The trades don't last very long. But there are times where we're going to get a dip, and it's not just going to be a short-term dip. That dip or that decline could last weeks or even months before the market then turns around, rallies, and eventually gets us out for a very small profit. Let me show you an example of this on the chart. I've found some examples on this chart, on the Oanda chart. Let's just make that a bit bigger. You can see that most of the time we get entries and then we get out pretty quickly. There's small little bounces. But there are occasions, like here on the 23rd of September 2014, actually the 22nd, we got the signal, and you can see that we bought on a dip, but then the market continued to go down and it didn't actually rally above our entry point and get us out for any profit until the 23rd of January 2015. So we held that trade for a matter of months and only exited for a small profit at the end of it. But every day we've got the trade open, we are incurring small financing costs. So in fact, while it does show a small profit, by the time we've paid the trading costs on that trade, that probably was a money-losing trade for that matter of months. That pretty much concludes the update on this strategy. To sum it up briefly, yes, it is still working, just as well as when I first developed it. However, as you might have gathered, this is not a strategy I personally trade. That being said, with a better method of risk control, this could be a useful strategy to some of you. If you're looking for strategies which do have risk control, then you can get my 22-page Beat the Market Strategy Guidebook. And in there, I list out 3 more rule-based Forex trading strategies. If you find the link down in the description, you can get that absolutely free at the moment. And for those of you who want more, even better strategies, then you should check out my trading course. The links for that are also down below. And in the course, I outline in detail 6 more trading strategies. Well, I hope you've enjoyed this update video. If you have, then please give the video a thumbs up. I'm going over a lot of older strategies at the moment, especially the ones which I've already published in videos years ago here on YouTube. So if you like these sort of videos, look out for some more in the coming weeks. So I hope to see you there on the next videos. But until then, this is Jared Goodwin, and thank you.